Hey everyone, it is Thursday morning, and that means we are bringing back Jonathan Twomley to the show. How you doing, Jonathan?
I'm great, Michael. How are you?
I'm doing very well. Thursday morning, it means we at least got to start with the unemployment numbers. The new employment claims came out today, 4.4. What does that make? A total of 26.4 million
Yeah.
lost in 5 weeks. We now have lost all the job creation since the Great Recession. It's amazing to see what could happen in 5 weeks.
Yeah. I think a lot of that is going to come back once we get the all clear, but really the issue is the timing and how much of it comes back. So I don't think, we're in for an extended period, of now they're saying it's about when the numbers come out for April, it'll be 15% unemployment, which is 5 points higher than the depths of the Great Recession.
Yeah.
So it's serious. And it's happened all at once. So that's a huge shock to the economy. People haven't had any chance to kind of like slowly ratchet down their expectations. It's all happened at once. I think there will be as I've said on numerous occasions here and elsewhere, I think that the shape of the recovery will be V-shaped, except that the right leg is going to be shorter. Right. So it'll come a lot as soon as we get the all clear, a lot will come back pretty quickly, but I think it just won't reach where it was before, because I think there'll be businesses that just don't make it. And I think there's going to be people who are just, concerned, right? They're wrongly, they're not going to want to go out. They're not going to want to go spend money. They're going to be very cautious, and that's going to rein in spending in certain areas. On the other hand, you're seeing like certain businesses doing very, very well at the moment. Supermarkets doing super well, right? And Amazon is hiring, and there's a lot of, in the economic activity has shifted, but so it's not all gone, right?
Right.
But there's definitely winners and losers from this situation, as because it's so unusual. It's not kind of an evenly distributed across the board loss. It's definitely, your restaurants and bars and any kind of places where people are gathering, casinos, movie theaters, all that kind of stuff is dead in the water. Airplanes, although they're still flying. I mean, you can still see planes flying around. I don't know who's on them.
It's got to be all cargo.
Yeah, I don't know what's going on. I mean, there are some people, I guess there's still some people flying, and I don't know how they're handling the safety issues with flying, but there's still some people flying. And but on the other hand, so those businesses are sucking wind. And I don't know if you noticed this one here. We're kind of riffing a little bit today. We're just talking about maybe we should have like a daily outrage section of the podcast.
Let's do it.
Because my daily outrage is cruise ships. The cruise lines now all seeking bailout money, and all of the cruise lines they're all domiciled overseas in tax havens.
Correct.
So they can avoid paying U.S. tax. And that makes them ineligible to collect money to collect relief money in the bailouts. Except now a bipartisan group of Congress people is working on amending the law to allow these basically tax scofflaws to feed at the trough of our taxpayer money. And I mean, my inclination is to say, screw them, let them fail. If they don't want to pay tax, then let them, they can go to hell.
Yeah, I agree 1,000%. If you are doing something and you're flagged somewhere else, go talk to their folks, not us. I'm okay if all the cruise ships go out. There will be another cruise company in the future. It is a proven business.
There'll be a lot of cruise ships for sale cheap.
Exactly.
Right? And you can probably start, and the executives of those companies will go out and start their own cruise lines.
Yeah, exactly.
And be able, or they'll just be reorganized, right? But they shouldn't
agree.
Let them go to Panama and get some bailout money from Panama.
Well, Carnival successfully raised, I want to say it was 2 or 3 weeks ago. They got a bunch of money from Saudi Wealth Fund. I think it was $6 billion. Might have been $3 billion. It was something, but it's not okay. No, if you're not paying taxes if you're not a U.S. citizen or business that pays taxes, not flagged here, yeah, non-starter. Don't even ask it.
Yeah.
Turn around, go to the other way.
Yeah, all those companies that went and did those, like, bought themselves out with their subsidiary in Ireland or whatever in order to avoid U.S. taxes. Like, they should just all go to Ireland and get money from them, because
Amen.
That's where they're paying taxes, and not out of. But of course, we know that won't work. That's not going to happen, because Congress will just, these are all politically well-connected businesses, and they will get Congress to do what they want Congress to do, unlike us. So
well, I hope we tell plenty of them to F off. And you're right. Yeah. I mean, this is interesting times. But yeah, that's a good daily outrage. I will scoff at that every time I hear that. But back to the kind of short-legged V, I've been thinking about for a while, what's this going to look like, right? The V and the U was kind of the easy discussion. Lots of people talking about the W. I actually heard for the first time something that generally feels good. Now it's called the Nike swoosh. The whole, just kind of that long tail, positive.
Well, that's kind of what we had in the last recovery, right? I mean, we had a very slow, steady recovery, and that's kind of, what they say happens when you have a debt crisis, right? Because you've got so much debt, the economy just can't roar back because so much money is just going into the repayment of debt.
Yeah.
And I think it's worse now because, on top of all the government debt that we accumulated the first time around, and now we're accumulating even more, there's all that corporate debt that all the corporations just took advantage of low interest rates and tax cuts and just bought their own stock, which now, has gone kablooey. So basically, you and I, through our our taxes, funded a bunch of, executives getting big bonuses last year because their stock prices were high. Yeah. And now the stock prices aren't even high anymore. And it just was all financial engineering, and it all went kablooey. So, good luck to them. But that's just not, I think that's also going to hold back the strength of the recovery when it happens, because a lot of those companies are so overburdened with debt that at reduced, some of them are just going to go belly up because at reduced economic levels, they can't afford to pay their debt, right? They just can't make debt service because they're so highly leveraged. But for a lot of others, so much money is going to be going into repaying that debt. And they were forecasting, of course, as people do. And I think especially as those Wall Street types do, when they borrowed that money, they were most likely forecasting like good times forever in terms of their repayments, and saying, oh yeah, we got this. This is not going to, burden us too greatly. And of course, with any kind of reduced economic activity, that goes out the window. So I think that's going to just be a drag on the recovery. So, we had kind of consistent 1.5% to 2% growth over the last 10, 12 years. I think we're going to see once we get out of this and start coming back, I think you're going to see like an initial burst because everyone's going to come back all at once. So you'll see like 10% economic growth in the first quarter when everybody comes back, or like, 75% of the people come back. It'll look amazing. Right. And then after that, you're going to see like, half a point of economic growth out for a very long time.
Yeah.
Because just
along really these lines, something that I've been waiting to talk to you about, given your expansive knowledge of economics, your history with your time in Japan with trips there, is it really feels like with everybody going out, well, not everybody, with many companies going out and just raising more debt, right, which increases the debt service. I think it's probably pretty likely that we kind of have a repeat of Japan in that it's kind of a balance sheet recession. It's not going to really be a recession, right? Because we'll have growth, but it's just going to be people having, where they used to maybe invest in capital or hire more folks or whatever. Parts of that growth is going to just have to go back to paying the debt.
Yeah. And I think that's true, but I think actually it's going to be worse than in Japan. And the reason for that is that the Japanese companies tended to raise money from their own like captive banks. So you'd have like these groups of companies that have banking relationships with a certain bank that they also partially own.
Right.
And also when they are issuing debt, a lot of it's being purchased by their group companies.
Yeah.
And so it's all like a big kind of incestuous circle.
Sure.
And then there's also in the public markets too. I mean, almost all the Japanese public debt is held by Japanese people, unlike us, where it's held by foreigners. So what that allows for in Japan is at least all that debt service that's being paid is being paid to other parts of the Japanese economy. It's not being sent over to China, all those interest payments.
Right.
It's also that those kind of incestuous banking relationships means it gets very easy to roll over the debt because they'll just keep on lending good money after bad because it's within their own group. Whereas here, I think you're going to wind up with, I could easily see a lot of sort of vulture capitalists and stuff pushing U.S. companies into bankruptcy.
Yeah.
Because they'll figure out a way to make money on that, right? So, so I think that it could be worse here because of the way that
let's just
the way that our economy is structured.
Yeah, let's play this out. And I just did a search on my phone because this is again something I wanted to talk about. Just in this whole idea of companies are going to stunt growth because they have to pay back debt. I'm sure there are plenty of examples, but the one I wanted to find for you is the owner of the Houston Rockets. His name is Tillman Fertitta. I don't know. He's a billionaire. Anyways, his wealth for the most part is made up of restaurants and casinos. Right? Talk about two bad businesses to be in right now.
Yeah.
He went out and raised $250 million for his businesses. Do you have a guess at what interest rate he was charged for that?
When was it? Just now? Just recently?
April 6th.
Oh, really? So this is post-corona.
Yeah.
North of 10%.
15%.
Wow.
That's like loan shark rates.
Yeah. And how is he going to, so this is obviously private money. I'm sure this wasn't from bank lenders that gave
money. It's, I'm sure it's, actually, let me click on the article, see what it says. But yeah, that's just a sign that, you can still raise capital in this market. It's just really expensive, right? This is
probably, go ahead.
No, go for it.
No, you go ahead. Oh, you were going to say.
I was just going to say that, this is a guy who came into this business really strong. I think he has, several hundred restaurants. He owns the Golden Nugget Casino. Again, he owns the Houston Rockets. I mean, owning an NBA, any sports franchise means you're loaded, right? And now he's essentially shut down. He's probably not a billionaire, at least on paper now, right? I mean, what's a restaurant empire worth today? A casino worth today? I don't know, right? So crazy.
I'm guessing. I mean, this is just rank speculation on my part, but I'm guessing that he's desperate, and somebody has thrown him this lifeline, but they're expecting that they're basically going to foreclose on his assets, right, and get them on the cheap. So, if you got, I think he's making a bet that the 250 will be, last him long enough to get through the crisis, and then he'll be back in business, and then he'll somehow
his plan for the 250 is takes him through the year. He's already laid off or furloughed or whatever the right word is. Hundreds of thousands of people. He's this 250 he calculates will take him to the end of the year, which his plan is, hope we're back to normal, right? That whole word of hope.
Right.
But yeah, it's interesting. It doesn't list the collateral that was used. I assume it is real collateral, not a signature loan, right? 15%. But yeah, it's interesting. Yeah,
I'm sure it's like on the real estate assets that he owns. Maybe it's on the Houston Rockets.
It could be. Yeah.
So.
That's interesting that the people can be loaning money high rates because they want to pick it up on the cheap. That's just that's genius. And this has happened before.
I think it's one of the only, either going to loan money for loan money, right? I mean, either going to loan money for a couple of reasons. Like one, you really believe that this is purely just a temporary liquidity shock, and that it'll come back to normal very quickly, and you can just make a really good rate of return in the meantime, right? Or you're thinking, and maybe you're thinking both. Maybe you're thinking either way it works out for you. They repay it, you get you've made
Yeah, 15
15% on your
points, not
money.
bad, right? Yeah.
Yeah, for 6 months, like that's
Yeah.
that's quite a handsome sum of money. And then the downside for you, quote unquote, is that now you're going to pick up like $1 billion worth of real estate for $250 million.
Yeah.
And and an interest in the Houston Rockets, which we all know as soon as that goes, when the NBA can start playing again. And frankly, I would expect that the sports teams are going to go back to playing in front of empty stadiums.
Yes.
Right. Because
TV.
they're making most of their money on TV anyway. Right.
Yes,
I mean,
correct.
and especially like something like, basketball or some other sports where they don't have huge arenas. Right. Maybe baseball gets a lot, collects a lot more money from the gate. But I think
basketball's 20,000 people, 18,000. Yeah. It's interesting, sure, but it's not. Everything.
I'm sure that the bulk of their money is coming from TV contracts.
Oh, clearly.
And so they can go back, and everybody's home, right? Probably the advertising rates will go up because everybody's home and they've got nothing to do.
Oh yeah, the viewership would be through the roof. The first game is going to have like Super Bowl level viewership. Yeah.
So I think that taking your interest in the Houston Rockets is probably a smart long-term move, right? If that's your collateral, I'd want that collateral. That's what I would want.
Exactly. You get to pick your collateral at this point. Sure, you can have my $250 million, but I want the Rockets. Yeah, I want 20% of the Rockets or whatever it is. Yeah. So that's interesting. Again, this is. I think we can. I think it's fair to say. Well, actually, this is something I wanted to propose to you. Everybody's talking about recession or depression, and I've always felt. I just feel bad calling what we're going through one of those. Now, I understand the numbers. I understand the comparison to history. I get all of that, right? I got an econ degree, and I've been looking at this stuff for 20 some odd years. But this feels more like we put our economy into a medically induced coma, which we've never done before. And we don't know how we're going to come out of it. And I don't like everybody calling it a recession. And now people are starting to call it a depression, given the calculated, unemployment rate is 17 and a half, and obviously will go higher. But it's not the traditional grinding, right? If you look at the depression, right, it was 12 years roughly, right? Mm-hmm. It was just a slow grind. And then,
it dropped off pretty quickly though in the Great Depression. And then once the stock market crashed.
Quickly, let's use context. Quickly wasn't 5 weeks, right?
No, that's
quickly
true.
Was
absolutely.
2.5 years, roughly the down leg, maybe 2 years.
Yeah, but they started having bank failures pretty quickly. But I'm going to have to go back and read my depression history.
Yeah, I think so. I think we need to look at it because it's.
I mean, I agree with you that this is unprecedented, mm-hmm. right? On the other hand, and it's unprecedented because it was intentionally done. Right. Yeah. So, I mean, in the sense that we did it to ourselves intentionally, not meaning that we tried to cause a recession, but I mean, we had to take extraordinary measures.
Yeah, we told a third of the economy to stop working.
Yeah.
That's what we did.
And I think the theory behind it is that, if we didn't try to take extraordinary measures to shut this thing down fast, then we'd still have all the economic damage, but it would last even longer, right? Because I think if you look, that's, I think, the theory behind it, right? To try to whip the coronavirus thing as quickly as possible, because, I mean, if you think about it, if there's really a pandemic and people are really getting sick and the hospitals are overwhelmed, then people are going to just stop going out on their own, right? They're not going to want to go to restaurants. They're not going to want to go to movie theaters. All those things are going to suffer a big hit anyway, mm-hmm. because of this. And that's what happened in the Spanish flu in 1918, right? I mean, there's some interesting stuff out there about the Spanish flu and how different cities in the US responded to it. And I think the comparison is Philadelphia and St. Louis, about how one of them very quickly got out ahead of the Spanish flu, shut everything down and bounced back very quickly. And the other didn't, and they wound up with a very prolonged downturn in their economy because the Spanish flu just kept on going on and on and on and on for a very long time. So people just stopped, going out and spending mm-hmm. money.
Yeah.
So I think the theory behind this is hey, if we can hopefully get this, maybe we can all withstand 3 months of quarantine, and mm-hmm. then we whip it and we're done, and then we come back, but as opposed to letting this go on for a couple of years and having people just like permanently change their habits and not shop. And,
Right.
So I think that's kind of like the idea behind it economically. But back to the original point is, yes, I agree that there's something different about this in the sense that it's not like the economy ran out of steam or
it's not a business cycle thing.
Right. Although lots of recessions are started by external events, right? So like the oil shocks of the 70s, right?
That's very true.
And those were, we didn't do them to ourselves, but that was true. Like OPEC basically causing two recessions in the rest of the world by jacking up oil prices, right? So, and nobody was, they suddenly did it and it happened very fast. So I think recessions do come from external events when the setup is there for it to happen. Like, but again, this time around, as we're saying, like, this is just so unusual because it wouldn't really, the economy could have already been in a depression, and if they shut the whole economy down, it would fall even more, right? Yeah. It's not like that. This kind of shutdown wouldn't affect the economy in certain circumstances, right? But it's, so that's what makes it. I agree with you. It's sort of conceptually, it's a little hard to get your head around it and call it like a recession or depression. But I think what's going to happen though is that once we come out of it, though, then we're going to have a recession.
Then the business cycle kicks in for sure.
Yeah, because we're just going to have reduced economic activity as a result of this, because
that's very true.
The businesses that don't come back, and because of all this corporate debt issue that we're talking about, that's going to be a huge drag on hiring. Yeah, I mean, I really do think there's going to be, right now, I think a lot of companies are operating under cover of Corona.
Sure. No, I agree with that.
They've furloughed all these people, and they don't have to own up to the fact that their balance sheets can't handle it.
I totally agree with that.
And I think what's going to happen is when the coronavirus lockdowns end, you're just going to see a lot of those people not rehired because
totally agree,
because they're just not, those companies just can't afford it.
Yeah.
And they're going to want to slash costs anyway.
Oh yeah. Yeah. So I think there's something that I'm feeling increasingly confident about as I kind of look to the world post this event. I think we're going to have a record number of companies, most small and medium-sized business, go out of business in 2020. They just weren't set up. They didn't have the cash reserves. The demand picture is different pre and post. We're going to have a lot of business go out. But I believe in the America, in the capitalist society. I believe we will have more companies created in 2021 than we've ever had before. Does that feel about right to you?
I think, I mean, look, if you look at the last recession, you saw a lot of, that's where like the gig economy came from. And a lot of people went out and started businesses and really out of necessity. And I think that's going to happen again. I have to say though, as an entrepreneur, one of the biggest impediments that I've seen out there towards entrepreneurship is the cost of healthcare, right? Like health insurance is such a huge drag. The cost of health insurance is such a huge drag on entrepreneurship. And it really tilts the scales in favor of big business.
True.
Because of the way that it's structured. Like if you have 1,000 employees, you can get really good insurance rates per employee, right? So, and it's not it's still really expensive, but it's not as expensive as if you are starting your own business.
Right.
And then you have to pay the individual insurance rates, which are just insane. Right. Yep. And so that, if you have a spouse who's working for a big company and you don't have to have you don't have to carry your own insurance, that's fine. But if you're a single person, or if you're both, working for yourselves or whatever, your insurance cost alone, you're probably going to pay more for insurance than you'll pay for rent.
Oh, for sure.
Maybe even than you'll pay for taxes. Like it's, depending on where you live, you might pay more in insurance than you pay in income tax, and depending on what your job is.
Yeah.
But I think I've been paying about the same you know, and it's, and I think that that's a big, you know, that's a big impediment to starting your own business. But I think something's going to have to give somewhere, because I think a lot of companies just not going to be hiring people back.
Yeah.
Right. And, you know, I guess some people have to start businesses, whatever, regardless of health insurance, just go without health insurance. But I think there's going to be more pressure to reform the system when you have more people having to pay for it themselves. Like, I think now some of the resistance to reform is because people don't really see the cost, right? It's a deduction on their pay stub. They're kind of like, it's all lumped in with taxes and all the other stuff that they hate, right? So they're just like, you know, I'm only taking home half of my pay, but they're not really thinking like, oh, this component is this much and this component is that much.
Right.
But I think if more people have to go out and like start a business and then write the check every month and see like how much it is that they're paying for like a family of 4 for health insurance, that, you know, they're going to be, and it's high deductible, and, you know, like you're still paying out of pocket on top of all that. Like, I think there's going to be a lot more pressure to reform the system, which I think will be good, because like there's no other country in the world where businesses have to bear the cost of health insurance. We're the only one that imposes that on business. So, and that, when you talk about like a drag on hiring, if a business has this enormous health insurance nut to carry, like how many more employees is that that they can't hire because they're just funding health insurance? And like you, as a small business person, like you might be able to fund more, you know, hire more people or spend more in advertising or whatever. This is all essentially like a big tax on you as an entrepreneur to be paying for health insurance out of, like, you know, on a company basis. So I think that may change, but I agree with you that I think there's going to be a lot of people who have to go into business for themselves because they just to survive. Right. And also maybe because once they're liberated from the corporate culture, they might be like, hey, you know, I don't really want to go back.
That's true.
So
could be.
They're going to have to figure out other ways to make money.
Yeah. So let's flip it to real estate, because I think I'm becoming increasingly convinced now that I think I'm 7 weeks into this kind of stay-at-home thing, that real estate investing, you know, in what works and what doesn't work kind of post this event is going to be different. Right. I think a lot of businesses will have to make and evaluate this, and we're not alone. I think real estate investors need to think about that. So have you given any thought to what this all kind of unwinds with, you know, by the summer? Let's just pick a date. What starts to look like?
Yeah. I mean, I've started thinking about this, about how this looks different in the future. You know, I think given human psychology, everyone's going to be pricing in another pandemic into what they're doing, even though the chances of another pandemic happening very quickly, I think, are pretty slim. Right.
Okay. Yeah.
So, but people are going to, like I said, you
pull it forward, recent memory. Yeah.
Yeah. Everybody's always, you know, every military is always preparing for the last war. Everyone's always preparing for the last recession. Right. It's just human nature. But that's going to it's going to impact risk taking. And I think I think people are going to be demanding higher risk premiums for properties. That's going to cause cap rates to go down. And I think, you know, I was also thinking even this morning about how I think syndication deals are going to be structured differently. And it's going to be a hard thing, I think, to pull off, to be honest. But I was thinking that, you know, so first of all, and this is going to also force returns to be higher, or risk premiums to be higher. But I think that, I think a lot of syndicators are probably out there thinking like, hey, I'm now behind on a preferred return in a way that, you know, I may never catch up from, right? And it's completely beyond my control, right? This is not a risk that anybody was contemplating when we went into this deal. Now, maybe we were contemplating the risk of a regular recession, and fair enough. Like, you know, I was telling everybody, these are my projections, and if a recession, you know, if I'm wrong and a recession happens and the projections are off, well, I have to eat that. But for something like this, that's like this incredible, you know, worldwide, you know, government enforced hit to the economy, nobody could have contemplated that. And I think as a syndicator, the idea that like you're now behind on the preferred return because everyone was thrown out of work and governments told everybody they don't have to pay rent. And like, none of this is, you couldn't have contemplated this in the first place. So it seems like the fair thing to do is like, just put a bracket around this period and say like, this doesn't count towards the preferred return, or we make it non-cumulative. You know, we start the clock ticking again next year, so I'm not behind this preferred return forever, or we tack it on to the end of the deal. And I think that going forward, that these deals are going to have some kind of language in them in the operating agreements that allows for the syndicators to not be stuck behind, like, just like I said, to put a bracket around this period of calculating the returns, so that they're not, you know, they're not the ones penalized with stuff like this. It's just the pain is shared, right?
Right. Yep.
And so either, and maybe you can structure it that you can do it based on a majority vote of all the unit holders, or, you know, so the syndicator isn't like unilaterally declaring an event that where it doesn't count anymore. But I think that there's going to have to be something structured into syndication agreements from now on that allows for, even though this scenario is probably unlikely to repeat itself soon, I think that you can now everyone can contemplate, well, there might be some extraordinary event that's beyond anybody's control or contemplation, that causes, you know, pain, and that pain should be, it shouldn't be the syndicator who's just the one penalized for that. And you know, so we're going to have some mechanism for recognizing that, or, you know, so it'll be interesting to see what's going to happen. But I plan on talking to some of my syndication lawyer friends about what they would propose, how they would structure this. Because I think that, you know, there are a lot of syndicators out there right now who, if this thing goes on for, you know, for 6 months, like, they will never catch up with that, with that preferred return. You know, if it's an 8 pref, right, and they're down at, they haven't made any distributions. Let's even say like they make no distributions for 2 quarters and then they go back to normal for the rest of the year, which is unlikely. They're down 4 points. That means they're going to, unless, depending on how their agreement is structured, but if it's structured so that they have to catch up before they participate, then they're going to have, then now you're looking at, well, next year they've got to make 12 points before they participate. And like, you just can't catch up with that, especially if you bought at the top of the market. If you bought at the bottom of the market and you, like, you know, that 8% is not such a big nut to hit, or you refied out and you don't have a pref, like, you're fine. But if you were in any kind of situation where you had this, you know, you haven't executed on your rehab yet, or you're still early into it, or, you know, it was just a buy and hold strategy that didn't require a big renovation, or whatever it was, if you're behind the pref now, it's, you know, if this goes on for much longer, it's going to be very, very hard to get out. And probably what's going to happen is not only will you be down, you know, maybe you'll be at 0 distributions this year, or maybe you'll be at a couple of %. So you're now down, you know, 4 to 6 points, but it's not going to be like you're going to make the pref next year, most likely either. Because probably the economy is going to be softer. And, you know, so you could have a couple of years where you don't make the pref and you're never going to catch up. Right. And even when you sell, you might not catch up. You still might be like negative in arrears. And so that's, I think that this situation should be addressed in operating agreements going forward.
Okay. Back to one of the things you said early in that is you think the risk premium will change. So let's just say the baseline was a 7% pref, you know, was kind of the average. So are you saying that in new syndications, you know, maybe ones that are initiated in 2022, let's just pick some time far away from today, you think that's going to have to go up to 9 or 10%?
And it does. In past recessions, it has. You know?
All right.
So I know, like, when I first got into the business, and this was 2011, investors were basically telling me, if you can't show me a 20 IRR, I'm not interested.
Got it. Okay.
And they wanted, like, an 8% preferred return was like the minimum. And I just heard from other syndicators who were in the business longer that, you know, in past recessions before that, they were offering 10% preferred returns. because that's what
Okay.
they had to do to get investors interested.
Yep.
So talking about like a 10% preferred return, for you as the syndicator to be making any money at all, you've got to be buying it like a 12 cap or higher.
Wow.
Right? So,
that'll have an impact on values. Oh my God.
yeah. So, you know, this is just what happens in recessions. Like everybody gets more risk averse. They want more certainty. They're not going to put their money out without higher returns. And I can't remember if we discussed this on a previous call, but a couple of weeks ago there was a survey that was circulated for institutional investors talking about how they would underwrite deals going forward. And they were I'll have to go back and find this again, but it was very interesting because there were something like 15% of these institutional investors were saying that they were going to underwrite negative rent growth.
Deflation.
Negative rent growth.
Wow.
So for them then if you're underwriting, they were also saying like they're going to underwrite negative rent growth plus go in at like no higher than 60% leverage. And they were also going to be demanding like, these very high returns.
Wow.
Right. So when you add all those things together, you're talking about a huge amount of cap rate decompression. Right. So
yeah, you shared a report with us yesterday where there was only, I think it was a point, maybe it was a 1.5 expansion in cap rate. And I think it was like 5% drop in economic occupancy and prices lost 33% or something like that.
Yeah. The combination of those of a relatively, small rise in cap rates plus a relatively small decrease in NOI, the combination of those two things will result in a huge value loss, right? So
wow. And then if you add these other things, I mean, I don't mean to be an alarmist, but what I think you're saying is some multifamily properties could drop 50% in value.
Yeah, in implied value, right?
Implied
because they just might not sell at all, and they'll just hold off the market. But I think anybody who's looking to sell in the next couple of years is going to be taking a big hit or refi. I mean, I think the danger.
Yes, refi. Yes.
The danger is refi, and those will be the properties that are forced onto the market because they won't, and I think, what's going to happen is what I saw the last time around. Like there were properties that were on the market for basically, they were going to sell, the owners are trying to sell them for the amount of the outstanding debt.
Yeah.
And that might've been too high.
Absolutely.
And the buyers were not interested because that was too high a price.
Yep.
And so those properties were just stuck in the market. The lenders didn't want to foreclose on them because they were going to take an instant loss if they did. Right. And because they knew the market value. So they were kind of like in a limbo period where
I remember
where, the loan was non-performing or only partially performing. They had to refi, they were in technical default, and they were just stuck because, until the lenders were prepared to do short sales.
Correct.
Then they just stayed there. And I think you are going to see a repeat of that, in the next couple of years.
Yep.
For any deals that have to refi, unless the owners are extremely well capitalized and can afford to put the additional capital in. I think a lot of the syndicated deals that were bought with bridge debt are going to, find themselves. You're going to see, I think, a lot of, deals that the rehab got part done and they're just stuck in like, partly done construction. And they could never, finish it. I think you'll see stuff where you've got, I don't know. I'm sure that a lot of those private loans too, and the bridge debt is probably restructured so it's callable at any time.
Probably.
So
yeah.
Unlike permanent debt, right, which is generally not callable. But I think some of this, this private money and these bridge loans are probably callable, and certainly construction loans are callable. I know that, and you saw that the last time around where, it's funny. Right across the street from me, from my apartment, there was a deal. It was in the middle of construction, and the lender called the loan.
Oh wow!
Causing the builder to go out of business. Then the lender went out of business because all its loans got called. So this thing this mortgage got like foreclosed on up the chain a couple times. It took about 5 or 6 years for it all to get worked out. It finally got rebuilt they finished the construction a couple of years ago. Wow. But it was like a half-built shell for a good 5 years because of that stuff. So I think you may see that kind of, chain of defaults where you have some thinly capitalized lender who, private lender who lent the money for the construction or for the for rehab, whose own loans get called from its lending source, and it's calling the loans on these deals, and now everybody's stuck in bankruptcy, and it's bad news.
Yeah, the other thing I want to talk to you about is what is deemed valuable post this event. Again, think 2021. As far as multifamily, let's stay in rental property and ignore office and retail and all that, because that's a nightmare right now. There are some of us, myself included, that thinks we are going to have, one of the outcomes like the Depression was the Section 8 program or housing assistance. I see that somehow being turbocharged. Either it's going to, they'll double the capacity, or they'll call it something else. I think housing assistance gets bigger after this. And then there are others that think, Class C kind of affordable housing is the worst thing to own today. So I don't know what your thoughts are there. Class A, B, C, it just seems like the world is going to be different after this.
Yeah. So before any of this happened, had arrived at my own conclusion that I didn't want to be in Class C anymore.
Okay.
Because of the recession risk of Class C. And I know that position is unpopular, or was unpopular, because there was a prevailing narrative that said, very simplistically, Class C is cheaper, so in a recession it will do better because everyone will go there. Okay. And I didn't agree with that because basically because of the weakness of the tenants.
Yes.
Right? And because of just the time lag that you would see between if there was to be any kind of like filtering down, as they call it, the time lag would be such that you would have to bridge a gap of really, really bad performance to get there.
For sure.
So now that being said, in that scenario, Class C, if you buy it at the bottom, could be a really good deal, right? Yep. Because the seller, whoever was before you took the hit.
Yes.
Right. You're now buying it at a good valuation where you can build in a big margin of safety, and you can now, in your underwriting, account for the worst, the credit risk of the tenants and all that kind of stuff. Yep. When you're buying C properties at a 5 cap, you're asking for trouble.
Correct.
You're just asking for trouble in a recession.
Yes.
That you've eliminated all of your risk premium, right? Which you are building into the deal for the very purpose of having cushion in a recession. You've given that all away to the seller, right? Because you convinced yourself that C properties are going to do great in a recession and you have no risk, which is insane, right? But if you're buying at the bottom, then C properties look attractive again. They look really attractive as a repositioning play at the bottom, right?
Yeah.
So, but at the top, they look terrible.
Totally agree.
So I think that for going forward, though, sort of what has value. So I had arrived at, and this doesn't really change my opinion, but that really like the B, because you've got stronger tenant base than C, right? And you've got less maintenance risk, right? You've got your systems are newer, they're not failing, right? As they are with C, right? And especially stuff like those plumbing systems and those kinds of systems, which you're not going to really replace on a rehab, right? Generally speaking, you're not going to go and like redo all the plumbing. That's an incredibly expensive thing to do, or go and replace all the water mains or whatever. I mean, this is a big job.
Yep.
So, you're only going to do that if you're buying extreme distress, right? If you're buying like a shell,
Yep.
and then you're going to just completely redo the shell, then you might go and redo all the plumbing systems and stuff. But you're not going to buy like an existing tenanted property and then replace all the plumbing, because
no
chance.
It's
too expensive.
Mm-hmm.
So the B space, you don't have that overbuilding risk like you have in A.
Exactly.
You don't have as much risk of your tenants leaving to buy cheap houses now.
Oh, that's true.
Right? You're still in a little bit more of the in the renter by necessity class. Not as much. I mean, you're on the borderline, right? So some of your tenants may go buy houses, but you're not. It's not like A, where like suddenly the value proposition just doesn't look so good, right? Plus, you've got overbuilt capacity.
Yes.
Right. So you're at a better price point than A, but you got stronger tenants than C. Sure. And if you look at your kind of distribution of unemployment. Now, this recession again is different. It's different, but it's not completely different. It's different in the sense that there's across the board unemployment because of shutdowns.
Correct.
Right. However, who are the people who are still working from home? Right. There are people who are working from home right now who are still getting paid. I know like professional friends who are working at Wall Street, they're lawyers, whatever they are. They're very busy working from home. They're continuing to get paid. For sure. They're not unemployed, right? But who is unemployed right now? It is your service workers.
Without question, the impact of the initial 5-week, 22 million shutdown has disproportionately hurt Class C, the average Class C tenant, without question.
Right.
Without question.
Right. So, and some of the Class B too. Right?
Yeah.
So Class A is probably unscathed from this, or not unscathed, but Class A is probably relatively okay, because a lot of those people are still working. And if they're like doctors, well, they're probably all being pulled into the COVID thing anyway. So they're working too. But maybe if it's like, there's like an orthodontist, say, right?
Maybe.
Who is renting, or a dentist, they're not being pulled into COVID treatment, but their office is shut down. Those people have savings to continue to pay their rent. Yeah. Right? So you're not seeing the impact in Class A. You're probably seeing it in Class B. You're definitely seeing it in Class C, where probably almost all of your tenants are out of work. Right. And so so even for this kind of unusual recession, I think you're seeing as you always see in every recession, the more education a person has, which is kind of like the only way they can really on a broad level figure out where people fall in the income distribution or the kind of whether they're professionals versus service. Usually they kind of look very broad brush at level of education. And the 4-year college degree holders have a very, very low unemployment rate. And they're, as compared to even today, as compared to people with a 2-year degree, as compared to high school degree, as compared to no high school degree.
You're right. And
it's very dramatic. And the other thing too is that, if you look at sort of, I think only something like 25 to 30% of the United States holds a college degree, right? So it's a relatively small proportion of the economy that's continuing to do well. And so everybody else it's really skewing towards the service and the C class tenants. So C is dangerous, B is better, I feel, in general. But that means at the bottom, when it's all value, then C is, you've de-risked the C, and it might be a good play.
Yeah. My question is more of a supply demand picture first. Because it's right. Let's just use 100 as the number, right? Going into this event, and let's talk about supply first, and then we'll do the same thing for demand, because I think this is going to be telling, and we may disagree. So if you talk about A, B, C supply side, my opinion first, right? I'm guessing in the apartment market now, multifamily, probably supply was 20% Class A, probably 60% Class B, and then 20% Class C heading into this event. Exiting this event, I guess in my mind, Class C grows some, Class B kind of stays at 60% and Class A falls. I mean, it just feels like the bottom gets bigger. But I don't know if I'm thinking about
in
that
terms
right.
of the supply.
Yeah, supply, sort of like what's in the market, what happens as properties get added. We're gonna, in 2025, we're gonna build less A's. Housing, cheap housing is gonna be a thing we talk about all the time, and maybe the cities get off their ass and build it. It just feels like the supply picture coming out of a recession. It just feels like affordable housing is going to be something we hear about for the next decade.
Yeah. I mean, you can't really build Class C. It's just because you can't build it that cheaply.
Okay.
I think what you've seen in the last 10 years, what I keep on hearing is that it only makes sense to build Class A because it's so difficult. It's so expensive to buy land and then to build it. The labor costs and the supply costs so high that people can only build Class A. That's been what's been said. I think that there's probably a lot of truth to that, but I'm sure that at the margins, there are probably some ways that they can change how they're building a little bit to make it a little cheaper. And you probably will see builders try to shift in that direction.
Well, let me just
a little
throw
bit
this
more where they're to go to Class B to kind of just go down, not build like the super luxury anymore, but build a little bit more basic stuff.
But again, this is all just pure speculation at this point, but couldn't the cities get to a point where they have so much clamoring for, and maybe it's Class B that gets built, that they just add incentives to, hey, if you're building quote unquote affordable housing, we're going to kick in or reduce expenses. And if you are building Class A, we're going to double your fees or something. I mean, they could change the rules of the game.
Yeah, I don't know. I mean, in a place like New York City, they already have a lot of those incentives in place, and like the requirements that if you build, like you have to build basically anything you build, you have to build 20% of it has to be affordable, and stuff like that. And it's not enough to really increase the supply. And I think it's not enough to really change the economics. Like I think the real issues in places like New York City and California are that first of all, land is so expensive that, and the land price will drop, which is good, but like off the bat, land price is so expensive. And then you've got, labor is expensive. And then you've got all kinds of regulations, like just the amount of review that these things have to go through. And frankly, like the wealthier your neighbors are, the more of a pain it's going to be to build anything. Because
not in my backyard.
And poor people don't have the political clout to stop stuff from happening next to them, but rich people do. So you can't really build. The wealthier your area is, the more opposition you're going to have to getting anything done. And the people who are opposing it have more means to fight you with, right? So at least the way that our system is set up in the United States. So I think this is you'll see this kind of anywhere. I mean, I think a lot of people portray this as a blue state, red state issue, and there's some of it there, but I guarantee you, like, try to go to like Dallas or Austin or Charlotte and build some big project in a wealthy neighborhood. Like it's not going to happen there either, right? So because those people will be up in arms about you building this thing that they don't want near their house, right? So,
no, I agree with you. So what about the demand picture? So that was kind of the supply thing, and I think you've nailed it again. What about the demand side? Do you see the demand picture changing? I just had this eerie feeling that the demand, we're gonna bifurcate even more, right? The middle is going to be hollowed out. People are going to be pulled down from the middle into the lower. I mean, I don't know. Maybe that's just
no. I mean, I think there will be a lot of demand at the bottom for sure, But I think then what happens is you start running into real affordability issues where there may be a lot of demand and people are bidding up the rents, but then the rents get to a point where, people have to double up to afford them, or they're going to have to change the way that they underwrite tenants, because I think, the way that they underwrite tenants now is they just look and see like, okay, what's their income and how much is the rent? But meanwhile, they've got all this consumer debt, they've got auto loans, and they just can't afford it. Like at some point, you just get to the point where they literally can qualify to pay this rent, but they actually can't pay the rent, and you get defaults right away. And I think I saw that happening on properties that I owned at the height of the good economy, where people come in and literally defaulting in their second month. Like they've got the money to pay first month's rent, and second month they're already in default, and they qualified. right?
Yeah, no, I remember.
So I think that in a bad economy, it's going to be even more of a problem. So I think that, you're going to, the way it's going to play out is in less household formation, right? So
no, I
people
agree.
just won't go out and rent their own apartments, right? They're, the whole like C argument has always been people need someplace to live. They do. It doesn't mean they're going to live in your apartment building though. They may go live in, they may go live with their parents, or may live with their friend, or they're going to move in with their girlfriend or their boyfriend before they were ready to, or they're going to like, your tenants are going to invite their friends into your apartment to help them pay the rent. And that doesn't mean that there's going to be like more people lined up at the door to rent your apartments just because people need someplace to live.
Yeah.
Right?
This is one of the, when I put together the supply picture, which I see, and the demand picture, something I see as an outcome is actually C-class tenants getting together, just like you kind of outlined there, boyfriend, girlfriend, mom, dad, whatever, and actually taking what used to be 2 C-class tenants and moving into B-class housing. They're just going to double up in a house, right? It's easier. You got yards, all of that stuff. Because at least my math, I have all of this stuff. 2 tenants, if they were to get together, could take their small 550 square foot apartments, which is 1,100 square feet when added together, take their rent, pay less in a house that's roughly the same square footage, and have their own yards and their own garage. And I think that's coming.
It may well do.
Yeah. So I think the single family homes see an uptick after this.
But even in by the same token, I don't even know where my phone is. I'm sorry. By the same token, I think the same thing can happen with your apartment. So you might have 2 tenants.
True.
The differential, like 2 1-bedroom apartments, the combined rent is much larger than a 2-bedroom apartment.
True. Right? That's very true.
Right. So
very true.
And probably even than a 3-bedroom apartment. And so you could potentially have, instead of having, 3 single guys renting 3 1-bedroom apartments in your property, they decide they're all going to move in together to a 3-bedroom.
You're right.
And they're each going to save,
$700
$200 a month by doing that.
Yeah.
So, so I think you'll see that kind of stuff happening as well, right? And even families families combining too. If they're related or they're close friends, they'll all move in together. And or the thing you'll see is the stuff that you don't necessarily even recognize, or but you'll see, those 1-bedroom apartments suddenly with 2 people in them.
Yeah,
and
you live in the living room.
Now you've got more water use, you've got more strain on everything, you've got more cars in the parking lot. Like you've got, it's not good for your property to be having more people living in the same space. Yeah. So, that's likely to happen too.
Wow. This has been a lot of fun, Jonathan. I always appreciate our conversations. You have a wonderful day. Stay safe, stay healthy, and we will talk to you next week.
You too, Michael. Thanks so much.
Yep.
See you next week.